Most investors identify the biggest risks to the economy as trade wars, the AI tech bubble, or the next interest rate decision from Jerome Powell. There is a visible disconnect between these headlines and market reality. Even as the Federal Reserve discusses cutting rates, stock markets suffer sudden bouts of volatility, and financial conditions remain stubbornly tight. While economic policy is debated in Washington, the massive amounts of liquidity fueling U.S. markets is largely anchored in Tokyo. The center of this dynamic is an obscure asset class, Japanese government bonds. For 30 years, these bonds have functioned as the duct tape quietly holding the global financial system together. While investors focus on the Fed for short-term cues, they often overlook a global liquidity engine that has been running in the background for 3 decades. This engine started in 1992, when Japan's massive asset bubble burst. The following lost decades were characterized by stagnant growth, flat wages, and an economy that effectively hit a 3-decade pause. To combat deflation, the Bank of Japan cut interest rates to zero and eventually took them into negative territory to encourage spending. This chart visualizes a policy called yield curve control. The Japanese government essentially superglued long-term interest rates to the floor, capping bond yields regardless of market demand. This created a crisis for Japanese banks, life insurers, and pension funds. They held billions in capital, but their own government bonds offered no return. This shift made Japan the world's largest net creditor, providing the capital that supports international debt markets as Japanese institutions began buying assets across the globe. This global expansion relied on the yen carry trade. The process begins with an investor borrowing yen at near-zero interest rates. The investor converts yen into dollars, buying U.S. treasuries yielding 4% to pocket the difference. With borrowing costs near zero, this trade expanded globally. Trillions of dollars flowed into U.S. tech stocks, commercial real estate, and emerging markets. Japan essentially became the entire world's ATM. At its peak, this trade was estimated in the trillions, making Japan the largest foreign holder of U.S. government debt. The entire system was built on one specific condition: the mathematical assumption that Japanese interest rates would stay near zero forever. That assumption broke in 2024. The Bank of Japan ended yield curve control and raised interest rates for the first time in 17 years. The math of the carry trade suddenly collapsed. Rising Japanese yields made borrowing yen and hedging currency risks more expensive, erasing the profit margin for global investors. The immediate result was a violent repatriation of capital. The S&P 500 dropped 6%, and the Nikkei 225 plummeted 12% in a single day, its worst drop since 1987. The cheapest source of global liquidity is no longer cheap. The capital flows that supported global asset prices for decades are now reversing. This is why investors are watching the wrong lever. The Federal Reserve only has direct control over short-term overnight interest rates. This scale shows how long-term rates, like the 10-year Treasury, are actually set. They are dictated by raw global supply and demand. The U.S. is running trillion-dollar deficits, requiring a constant supply of new debt. As Japanese demand fades, the market must offer higher yields to attract new buyers, pushing long-term rates higher even if the Fed cuts short-term rates. This results in a steepening yield curve. Short-term rates fall, but yields setting the price for mortgages and corporate debt remain elevated. Ray Dalio identifies the bond market as the backbone of all finance. The supply and demand for these bonds determines the baseline return for every other global asset. These higher baseline yields affect the stock market directly. With long-term yields elevated, investors pay lower multiples for company earnings, compressing valuations across the board. In the housing market, 30-year mortgage rates are anchored to these long-term yields. Without a significant drop in the 10-year Treasury, mortgages will not return to the 3% levels of the previous decade. Corporate credit follows the same rule. Higher borrowing costs slow down business growth and restrict the flow of capital that drives the global economy. The era of guaranteed liquidity and reliable foreign debt buyers is over. These structural shifts in the bond market now define the global cost of money.